People love to believe they're smarter than the system, especially when it comes to money they don't actually have. I've watched this pattern repeat itself for decades across bull markets, crashes, recessions, recoveries. Different generations, same behavior. Smart people, educated people, high-income people. And somehow they all fall for the same illusion. They convince themselves that debt is manageable, that it's under control, that it's part of the game. They call it leverage. I call it fragility. Debt doesn't feel dangerous at first. That's why it works. It shows up dressed as opportunity, cheap money, flexible terms, monthly payments that look harmless. It tells you you're being efficient, that you're optimizing, that you're using capital intelligently. And that's exactly how people walk into financial disasters, one perfectly reasonable justification at a time. The real danger of debt isn't the interest rate. It's the normalization. The moment owing money feels ordinary, you've already crossed a line. You stop asking whether you should owe. You only argue about how much. That's when the system owns you, even if you don't realize it yet. If you're sitting there right now debating whether to invest or pay off debt, let me be blunt, you're already on the wrong side of the fence. The debate itself tells me something important. It tells me you've accepted the idea that owing money is just part of life, that it's unavoidable, that it's something to manage rather than eliminate. That mindset is how people get trapped for decades. I've never met anyone who went broke without owing someone else money first. Not one. That's not ideology. That's pattern recognition. People don't implode because they lack intelligence. They implode because they remove their margin for error. And debt does exactly that. It shrinks your room to breathe. It turns small mistakes into permanent damage. People love to tell themselves stories about their debt. My debt is cheap. My returns are higher. The math works. That logic only holds in a world where nothing goes wrong. And if there's one thing markets guarantee, it's that something will always go wrong. Cycles turn. Liquidity disappears. Rates change. Volatility shows up uninvited. Debt doesn't care about your projections. It collects on schedule. Here's the part most people don't want to admit. Debt doesn't just live on a balance sheet. It lives in your head. It changes how you think. It shortens your time horizon. You stop thinking in years and decades and start thinking in months and payments. And the moment that happens, you're no longer investing. You're reacting. You're managing survival. You can't think long term when you owe short term. You can't wait patiently when the clock is running against you. You can't stay rational when missing a paycheck or a market dip threatens your stability. That pressure rewires decision making. It forces urgency where patience is required. And patience is the most valuable asset an investor can have. The smartest investors I know don't sleep well because they own great assets. They sleep well because nobody owns them. Freedom isn't a motivational slogan. It's a structural advantage. When you don't owe anyone, you control your timeline. You can wait. You can say no. You can walk away from bad deals without fear. That optionality is worth more than any return you'll ever calculate. I see people brag about beating the market while carrying high interest debt. That's like bragging about swimming faster with weights tied to your ankles. You might look impressive for a while. Eventually, gravity wins. Compounding doesn't care about confidence. It doesn't care about intelligence. It just works relentlessly, mathematically, without emotion. Debt compounds too. That's what people forget. And unlike investment returns, debt compounding is guaranteed. It never takes a bad year. It never pauses for recessions. It doesn't care if markets recover in 2 years or 10. The payment is due next month. Always. When I was younger, people still remembered real financial pain. They had lived through periods where credit vanished overnight, where banks didn't negotiate, where leverage destroyed lives. Debt was feared because it was understood. Today, debt is marketed like a convenience, like a lifestyle enhancer. Everyone uses it. Nobody thinks it's dangerous, but debt doesn't kill you quickly. It kills you quietly. It waits for bad timing. People say they're investing with borrowed money. No. They're gambling in formal wear. The difference between a gambler and a leveraged investor is honesty. The gambler knows he's gambling. The leveraged investor believes the spreadsheet will save him. It won't. I've seen leverage wipe out people 10 times smarter than you or me. Intelligence doesn't protect you from math that compounds against you. Debt has perfect discipline. It never sleeps. It never gets tired. It never forgives. You can't build rational wealth with an irrational burden on your back. You can't call yourself free when someone else has a claim on your future income. Debt taxes your mind before it taxes your wallet. It turns every decision defensive. You stop thinking about opportunity and start thinking about survival. People ask, what if my debt is at 3% and I can earn 7% in the market? That question tells me everything I need to know. It assumes smooth returns. It assumes stable income. It assumes no drawdowns, no job loss, no volatility. Debt doesn't operate on assumptions. It operates on contracts. Markets are probabilistic. Debt is certain. That asymmetry is deadly. This isn't complicated. You don't need a spreadsheet. You need common sense. If you owe money, pay it off. If you're free, stay free. Because freedom compounds better than any asset class I've ever traded. Wealth isn't about how much you make. It's about how little you owe. When you owe nothing, every dollar you earn belongs to you. When you control your time, your decisions, your stress, that's real wealth. Before you chase the next investment, ask yourself one question: are you building freedom or just decorating a prison you haven't noticed yet? People like to say money is emotional. It isn't. People are emotional. Money is arithmetic. And arithmetic doesn't care how confident you feel, how smart you think you are, or how good your intentions might be. It just adds and subtracts. And when debt enters the equation, the math becomes brutally one-sided. Let's strip this down to first principles. No theories, no market slogans, just numbers you can write on a napkin. If you owe $10,000 at 15% interest, that's a guaranteed loss of $1,500 every single year. Guaranteed. No volatility, no uncertainty. A perfect negative return. You cannot diversify it away. You cannot hedge it. You cannot wait it out. It compounds against you with machine-like precision. Now ask yourself a simple question. Where are you going to find a guaranteed positive 15% return in the market? Not a hoped for return, not an average over decades, a guaranteed one you won't. Not legally, not consistently, and certainly not without taking real risk. Yet every day I watch people chase theoretical upside while ignoring guaranteed downside. They'll debate whether they should own more tech stocks or more energy stocks while their credit card quietly compounds faster than any of those companies ever will. That isn't investing. That's an intellectual theater. It looks sophisticated, it sounds smart, and it's financially illiterate. You don't fix a leaking boat by installing a faster engine. You fix the hole. Debt is the hole. Investing before you fix it is just rowing toward disaster more efficiently. People love averages. The market averages 10% a year, fine, over long periods, with deep drawdowns along the way, with years where returns are negative or flat, and with emotional stress most people dramatically underestimate. Meanwhile, your lender wants their payment next month. The market doesn't care if you need liquidity. Debt does. This is the mismatch that destroys people. Investments operate on long-term probabilities. Debt operates on short-term certainty. When those two collide, certainty wins. When you owe money, you are running a race with a clock you don't control. You are betting that market's income health and timing will cooperate long enough for your strategy to work. That's not investing. That's dependency. Here's what debt really does. Compresses your time horizon. It forces you to think in weeks and months instead of years and decades. And that shift is fatal to good decision making because almost all great investment outcomes require time, and time is the one thing debt steals from you. People underestimate how much clarity costs. When the meter is running, you don't think clearly, you think urgently. Urgency is the enemy of rational behavior. It makes you sell too early, buy too late, and chase narratives you would never touch if you weren't under pressure. Debt taxes your mind before it taxes your wallet. It turns every market move into a personal threat. A normal correction feels like an existential crisis. A temporary drawdown becomes unbearable. And once fear enters the equation, discipline leaves. I've watched investors with great instincts abandon them under pressure, not because they became stupid, but because debt forced them into short-term survival mode. They weren't thinking about opportunity anymore. They were thinking about payments. This is why I say debt creates fragility. It removes your margin for error. When you have no debt, you can be wrong and survive. When your leverage being wrong, even briefly, can end you. People love to argue that debt is acceptable if it's low interest. That's missing the point entirely. The interest rate is not the risk. The obligation is. The obligation doesn't care if rates are low today. It exists tomorrow and next year and during the next recession. Markets move in cycles. Anyone who has been around long enough knows this. Liquidity expands, then contracts. Risk appetite rises, then disappears. And when that shift happens, debt doesn't adjust. It enforces, I've seen people obsess over optimizing returns while ignoring the guaranteed drag of their liabilities. They'll spend hours tweaking portfolio allocations while hemorrhaging interest every month. That's not sophistication. That's misprioritization. Here's the uncomfortable truth. Paying off debt is the highest risk-free return most people will ever earn. It's boring. It doesn't make for exciting conversation, but boring survives. Excitement is how people meet margin calls. You don't need to beat the market to build wealth. You need to stay in the game. And debt kicks people out of the game early. People underestimate how devastating interruptions are to compounding. Compounding only works when it's allowed to run uninterrupted. Debt is an interruption machine. It forces you to liquidate at the worst times. It forces you to act when patience would have paid off. The irony is painful. The very people who talk most about compound interest often sabotage it by carrying debt that compounds in the opposite direction. They're running uphill while telling themselves they're making progress. I've said this for years. The most dangerous word in finance is assume. Assume returns. Assume stability. Assume nothing goes wrong. Debt turns assumptions into liabilities. If you really want to understand investing, understand this. Wealth isn't built by maximizing upside. It's built by minimizing forced mistakes. And debt guarantees forced mistakes. When you eliminate debt, your relationship with markets changes. Volatility stops feeling personal. Downturns become opportunities instead of threats. You regain the ability to wait, and waiting is where money is made. Freedom gives you patience. Patience gives you discipline. Discipline gives you returns. Debt does the opposite. It steals patience. It breeds urgency. It creates fragility. And fragility is fatal in markets that are inherently volatile. So before you worry about optimizing returns, eliminate guaranteed losses. Before you chase upside, remove downside you can control. Because the math is simple, even if the psychology isn't. Arithmetic doesn't care what you believe. It only cares what you owe. People love the word leverage because it sounds intelligent. It sounds engineered. It sounds like something professionals use. But strip away the jargon and leverage is just borrowed confidence. It's the belief that the future will cooperate long enough for you to look smart. And markets have a long history of humiliating that belief. Leverage gives you the illusion of control. It makes small successes feel like proof of skill. A few good trades, a rising market, easy credit. Suddenly people think they've figured it out. They start believing risk has been tamed. That's when leverage becomes lethal. Not when things are bad, but when things are good and confidence is high. I've seen this movie more times than I can count. It always starts the same way. Someone borrows to accelerate gains. They tell themselves they're being rational, that they're using capital efficiently, that they're smarter than the average investor. And for a while, it works. The numbers look great. The confidence builds, they feel validated. Then the cycle turns, markets sneeze, liquidity tightens, rates move, one position goes against them. And suddenly, everything they built on leverage starts collapsing like wet cardboard. Not because the idea was terrible, but because the structure was fragile. Leverage doesn't forgive bad timing, it amplifies it. This is the part people don't understand. Leverage doesn't just magnify returns. It magnifies behavior. It magnifies fear. It magnifies impatience. It magnifies mistakes. And human behavior is the weakest link in finance. When you're leveraged, you don't get to be wrong for long. You don't get to wait. You don't get to sit through volatility. You're forced to act at precisely the wrong time. And forced action is how capital gets destroyed. People say leverage is a tool. Sure, in the same way a chainsaw is a tool. In expert hands, it's powerful. In careless hands, it's catastrophic. And most people, financially speaking, are careless, not malicious, not stupid, just overconfident. Leverage removes your margin for error. And margin for error is everything. Without it, even a small mistake can end you. That's why I've seen more investors ruined by leverage than by bad ideas. A bad idea might cost you money. Leverage can cost you the game. If you're highly leveraged, you don't own your assets. They own you. You're just renting the illusion of prosperity, and rent always comes due, often at the worst possible time. People justify leverage when interest rates are low. That's one of the most dangerous rationalizations in finance. Low rates don't eliminate risk. They hide it. They encourage excess. They make people forget that conditions change. Playing with leverage because rates are low is like playing Russian roulette because the odds look favorable today. Eventually, the chamber turns, and when it does, leverage doesn't wound, it kills. Here's something I've learned watching markets across cycles. The real risk isn't volatility. The real risk is fragility. Volatility is survivable if you're built to endure it. Fragility isn't. Leverage creates fragility by design. It converts temporary setbacks into permanent losses. A drawdown that would be a footnote for an unleveraged investor becomes a career-ending event for a leveraged one. People think being aggressive makes them strong. It doesn't. Strength comes from the ability to absorb shocks, from resilience, from not needing the world to cooperate perfectly for you to survive. When you're leveraged, your temperament deteriorates. You can't stay calm. You can't think long-term. You can't sit still. And once fear enters the equation, intelligence leaves. I've seen brilliant people make cowardly decisions under leverage, not because they lost their skill, but because their structure forced them to. This is why the best investors don't try to be the smartest. They try to be the last one standing. That's a much smaller target and a much better one. I've always believed that if a deal needs leverage to look attractive, it probably isn't. The best opportunities work, even when funded conservatively. They don't require perfect conditions. They don't depend on cheap money staying cheap forever. The moment your success depends on the kindness of creditors, you're no longer an investor. You're a hostage. I've heard people brag about borrowing at 3% to earn 6%. I tell them the same thing every time. You're earning 3% and risking 100%. They don't like that answer. Most people don't. They prefer a pleasant illusion to an unpleasant truth. Leverage makes you feel sophisticated right up until the moment it exposes you. And exposure always happens eventually. Markets don't move in straight lines. Cycles don't announce themselves in advance. And leverage has no patience for surprises. The graveyard of capitalism is filled with smart people who optimize their balance sheets. They weren't dumb. They were overconfident. They believed risk could be engineered away. It can't. I've said this many times. If you can't sleep at night, you're over-leveraged. If a normal market correction threatens your plans, you're over-leveraged. And if you need good luck to stay solvent, you're not investing. You're speculating and hoping for mercy. The market doesn't reward hope, it rewards resilience. The irony is this: people use leverage because they want to get rich faster, but leverage actually slows real wealth creation because it forces interruptions. It kicks you out of positions at the worst times. It prevents compounding from doing its work. Compounding needs time. Leverage destroys time. The best investors I've known built their fortunes by avoiding situations that force them to act. They want to control over when to move. Leverage takes that control away. So if you want one rule to remember, make it this: never build a financial structure that requires favorable conditions to survive. Because conditions will never stay favorable forever. Leverage makes you fast in good times and dead in bad times. Freedom makes you patient in good times and powerful in bad times. And markets, in the end, always reward the patient survivors. Most people think wealth is a destination, a number, a finish line. They imagine a moment where they finally arrive and everything feels secure. That's not how it works. Wealth isn't a place you reach. It's a condition you create. And that condition is freedom. Freedom isn't about how much you own. It's about how little you owe. It's about whether anyone else gets a vote in your decisions. The moment someone else controls your timeline, your cash flow, or your risk tolerance, you're no longer free. You're negotiating with obligations. Debt doesn't just sit quietly in the background. It shapes behavior. It changes what you're willing to tolerate. It influences how you talk to your boss, how you react to markets, and how much risk you can actually afford to take. People think they're making independent choices, but they're really managing constraints. When you don't owe money, your world expands. You can walk away from bad deals. You can say no to opportunities that don't meet your standards. You can sit through volatility without panic. That optionality is priceless, and most people never experience it because they trade it away early for convenience. Debt shrinks your world. It turns every decision defensive. Instead of asking, is this a good opportunity, you ask, can I afford to wait? And that's a very different question. One leads to growth. The other leads to survival. I've seen incredibly talented people lose their edge, not because they became less intelligent, but because they became constrained. They were constantly calculating what they owed instead of thinking about what they could build. Their thinking narrowed, their risk tolerance evaporated, and eventually their judgment suffered. People underestimate how corrosive financial pressure is. It doesn't make you sharper, it makes you reactive. It forces short term thinking in environments that reward patience. And patience in investing is the ultimate advantage. Here's something I've learned over time. The best investors don't need to act often. They need the ability to act when it matters. And that ability disappears when you're buried under obligations. When debt is present, you don't choose your moments. They choose you. Freedom gives you time. Time gives you clarity, and clarity gives you an edge. When you're debt-free, volatility stops feeling like a threat and starts looking like information. Market downturns become opportunities instead of emergencies. You can buy when others are forced to sell. You can wait while others panic. That's not skill, that's structure. Most people think discipline is about forcing yourself to act. In reality, discipline is about not being forced to act. It's about removing the pressures that make bad decisions inevitable. Debt introduces those pressures by default. I've watched people make absurd investment choices just to catch up. They chase speculative assets. They jump into crowded trades. They listen to loud voices promising quick returns. And the whole time, they tell themselves they just need one good break. That's not investing. That's desperation wearing a spreadsheet. The irony is brutal. People in debt often work harder than anyone else, yet their effort compounds for someone else. Their time becomes interest income. Their stress becomes yield. And the system doesn't care how hard they're trying. You can't buy peace of mind on credit. You can only rent it temporarily before the bill arrives. That's why I never understood the recession with good debt versus bad debt. They both tax your freedom. One just does it more politely. When you remove debt from your life, something fundamental changes. You regain control over your future. You stop making decisions out of fear. You stop tolerating situations that drain you. And that shift compounds in ways most people never measure. The true return on eliminating debt isn't financial. It's psychological. You get back your optionality. You get back your patience. And patience, as I've said many times, is the rarest form of intelligence in markets. I remember early in my career realizing that independence was the real advantage. Not leverage, not complexity. Independence, the ability to wait without pressure, to say no without consequences, to survive without needing cooperation from the world. That advantage compounds quietly, relentlessly. People love to look rich. They lease the car, they stretch for the house. They borrow to invest, they build impressive lifestyles. But what they've really built are beautiful cages, and they're too busy decorating them to notice the lock. Complexity doesn't make you smart. Simplicity makes you safe. And safety is what allows long-term thinking. I've watched cycles where debt-fueled confidence looked brilliant on the way up and ridiculous on the way down. The debt. Free always look boring until they suddenly look wise. That's a trade-off, and it's worth making. Freedom is not exciting. It's quiet. It doesn't announce itself. But it shows up when others are forced to compromise. It shows up when markets dislocate. It shows up when patience is rewarded. Most people never realize that financial freedom is not about accumulation. It's about subtraction. Subtract obligations, subtract pressure, subtract urgency. What's left is clarity. And clarity is the foundation of every great investment decision I've ever seen. So when people ask me what they should focus on first, returns or risk, I tell them neither. Focus on structure. Build a life where you don't need perfect outcomes to survive. Build a position of strength. Because when you're free, you don't need to chase opportunity. Opportunity finds you. And when that happens, you're no longer reacting to the market. You're responding to it. On your terms, that's not just good investing. That's a good life. If there's one lesson markets teach over and over, it's this: you don't have to be right often. But you do have to survive always. Most people approach investing like it's a sprint. They want fast results, big wins, proof that they're smarter than the system. But markets don't reward speed. They reward endurance. And endurance isn't glamorous. It's quiet, it's boring, it's invisible while it's working. The real objective isn't to make the most money this year. It's to still be standing 10, 20, 30 years from now when the real compounding happens. And compounding only works if you're still in the game. Every market cycle creates new stories of brilliance and failure. The failures rarely come from stupidity. They come from overextension, from people building financial lives that only function under ideal conditions. And ideal conditions never last. I've watched entire careers disappear because someone couldn't tolerate a temporary setback. Not because the thesis was wrong, but because the structure was fragile. Debt, leverage, lifestyle inflation. All of it quietly erodes resilience until one bad year becomes fatal. The market doesn't care about your intelligence. It doesn't care about your intentions. It only responds to positioning. If your position can't survive stress, it will be eliminated. That's not personal. That's math. People ask me all the time what my edge is. They expect some complex answer, some secret insight. The truth is simpler and far less exciting. My edge is that I don't need to be right tomorrow. I can wait. And waiting is a weapon. When you don't owe anyone, when you're not over-leveraged, when your lifestyle doesn't demand constant cash flow, time bends in your favor, you stop rushing decisions. You stop chasing narratives. You stop reacting to noise. And suddenly, the game slows down. Most mistakes in investing aren't analytical. They're emotional. People buy because they're afraid of missing out. They sell because they're afraid of losing what they have. Both come from the same place: pressure. Remove the pressure and judgment improves. The market is a master manipulator of emotion. It tests patience, conviction, and humility. It lures you into believing this time is different. It punishes arrogance and rewards discipline, but only after long periods of boredom. That's why staying in the game is the ultimate skill. Not prediction, not speed, not complexity. You don't need to catch every rally. You don't need to call every top. You just need to avoid catastrophic mistakes. And most catastrophic mistakes come from violating one principle: never put yourself in a position where you're forced to act. Forced selling is how fortunes disappear. Forced decisions are rarely good decisions. The best investors I know design their lives to avoid force. They build buffers. They keep optionality. They leave room for error. That's not weakness. That's wisdom. People confuse confidence with courage. Real courage is the ability to sit still when everyone else is moving, to look wrong for a while, to tolerate discomfort without panicking. And that only comes when your foundation is solid. I've seen people outperform the market for years and then give it all back in a single bad decision, not because the market changed, but because they did. They stopped respecting risk. They stopped prioritizing survival. Markets are unforgiving to those who forget the basics. Liquidity matters. Structure matters. Patience matters. Here's the truth most people don't want to hear. The biggest enemy of long-term wealth isn't ignorance. It's impatience. It's the need for validation. It's the desire to prove something to yourself or to others. The market doesn't reward ego. It exploits it. If you want to build real wealth, focus less on what you can gain and more on what you can avoid losing. Avoid leverage that removes your flexibility. Avoid lifestyles that trap you. Avoid narratives that promise certainty in an uncertain world. Certainty is expensive. Optionality is cheap if you choose it early. The best years in investing often come after the worst, but only if you're still around to experience them. That's why resilience is the most valuable asset you can own. It doesn't show up on a balance sheet, but it determines every outcome. Staying in the game means accepting that you'll be wrong sometimes, that you'll miss opportunities, that you'll look foolish occasionally. That's the price of longevity, and it's a price worth paying. I've never met a great investor who didn't survive periods of underperformance. I've met plenty who didn't survive overconfidence. In the end, markets don't crown the boldest or the fastest. They reward the patient and the prepared, the ones who understand that wealth isn't built by dramatic moves, but by consistent survival. So if you remember nothing else, remember this: design your financial life so that you don't need luck to succeed. Build a structure that can absorb shocks. Give yourself time, because time is the one advantage the market can't take away unless you hand it over voluntarily. Stay humble, stay liquid, stay patient, and most importantly, stay in the game.